Hi, and welcome to this financial modeling / financial analysis of acquiring a new company. So I've got a spreadsheet here on acquiring a new company, and I'm going to work on the spreadsheet. So the first thing I'm going to do is there's a couple of things I have to do before I get started. So here's the initial data. So we'll just pretend like my boss sent this over to me, and this is what all he sent was this initial data and some questions asking me to make a recommendation at the bottom. So I need to now create a professional response to this analysis. So the first thing I'm going to do is I'm going to resize column A. Okay. Now I'm going to increase the scale of this, size of this, so it's more clear, so you can see it better in the video here. All right. Now I'm going to freeze the panes. I'm going to click freeze panes here. So this way I always have this year 1 through 6 visible as I'm scrolling. All right, now I'm going to set the print area. It's going to set it up to the analysis up here. And I'm going to say go to page layout, set print area. I'm going to do a page setup. I want this to fit this to one page. I want to do landscape. I'm going to adjust the margins a little bit. I'm going to add a header and a footer. So I'm just going to say confidential. And in the footer, I'll just put page 1. And then the sheet. I can put rows to repeat at the top here. But this is mostly if you have a multi-page sheet, which I really don't have. I'm going to set that anyway, rows to repeat at the top. And then I'm going to set OK. And I'm going to hit print preview. For the Mac, the print preview is Windows button or Mac button, Command button P. And I'm going to see that, okay, so this page setup is okay. Okay. So that's always the first thing you should do is set the print range and adjust the viewing area so you have a good work area and freeze the panes. I would also suggest that you run a spell check on to make sure that nothing is spelled incorrectly. Okay, so now that little prep work is done, I'm going to rename the sheets. So this, I'm going to put just going to put analysis here and here. I'm going to rewrite this sheet. Executive summary. So we'll get to that later. The executive summary actually should be the first tab, and the analysis should be the second tab. And then to make them pop a little bit, I'm just going to change the color by right-clicking. You'll see that the color part will come up. Just makes the sheets pop out a little bit more. Now, we'll get to the executive summary at the end. So the first thing we're going to do here is we're given some data. So the data is saying here's the revenue per customer that's escalating as it goes through. Here are the new customers that are going to be expected each year, the total amount of new customers. But this is just going to say, we don't want to, we can say customers or new customers. I'm fine with that. Customer support for each year, new office space that we're going to have to pay for each year, sort of a rent on the office space. Payroll, and you can see payroll escalates with people want raises every year, and the capital investment. So the capital investment is basically what I'm paying for to buy this company. I'm paying $800,000 to buy the company. Okay, so this is our case study data up here. Now we have to do our financial projections. So we have our revenue. So our revenue is this, year 1 is already calculated. So I'm just going to go ahead and calculate year 2. Now year 1, I see some inconsistencies already. You see how the dollar sign's away from the number, and here the dollar sign's next to it. So what this is here is this needs to be formatted into the currency and take away the zeros. So once I have it, I could double click this format paintbrush, and anywhere where there's an incorrect format, I can correct that. These are correct. Okay, so we're good. And then I'm going to, what I'm going to do is I'm going to highlight this column. Oops, undo that. I'm going to highlight this column, do the format painter brush, and move that over to these columns. So that way, all the cells, when I start working, will come up with a similar format, which is critical. You want to have everything look uniform. Okay, so revenues. So revenues are clearly going to be the revenues per customer times the customers. And that's how we calculate our revenue. The customer support is going to be our customer support amount times the number of customers. So our total cost of goods sold so our cost of goods is going to be just our customer support. So obviously this is a business where we're providing a service, and that service is going to be this customer support that we're providing, and not sure what that service is. It doesn't really matter for this case, but this is going to be our cost of goods sold, is this customer support that we're providing. So this is obviously not based on a material company, like selling bicycles or something like that. So my total cost of goods is just going to be this number here. Now the gross profit will be our revenues minus our total cost of goods sold. Our gross profit margin is going to be our gross profits divided by our revenue. So we always want to see that our revenues are increasing and our profit margins are increasing. So you see, with a service-based company, the profit margins are very decent. And in this particular case, because we're not including our payroll, or these are obviously we're just including the direct costs of customer support for the company. Everything else is going to go into the operating expenses. So I'm going to make this bold since this is more of a title. And office, I'm just going to say equal office space. Payroll equal payroll. Depreciation. So depreciation, we're going to calculate down here. So we have our capital investment, and we're going to depreciate this over 6 years, sort of a straight line method. So we're just going to depreciate, it's not 25% a year, let's take that out. We're going to depreciate it, basically take this number, I'm going to divide by 6, and we're depreciating it 1/6 of each year. So this depreciation amount is, I'm going to lock down the cell with absolutes. I'm going to put F4, which puts dollar signs in front of each of these to lock that down. And I'm just going to move that here. Okay. All right, so total operating expense is going to be office plus payroll plus depreciation. And then operating income is going to be gross profit minus operating expense. And actually, I noticed that there is an error here. So you see that should be expense. So even though it's a correct, the word's not misspelled, it's just misused. So let me correct that. Okay. So it should match here. Okay. All right, so moving on. Operating profit margin is going to be the operating income divided by sales. So we could call this revenue. Sometimes it's called sales revenue. Both are correct. It might just be sales, sales revenue, net sales, net revenue. Okay. So already in the second year, we become operating profitable. And so that's a good thing. And that's because we have so few customers when we first start up. And then when the customers expand, we start becoming more operating profit. Now, we're going to do a tax at 21%. So the first year, we had a loss. So this is a tax credit. Typically, we just take the operating income and we multiply by, in this case, 21% to get our tax. So here is the tax credit. So I put a little note here that this is a tax credit. This is a regular tax because we lost money here, so we get a credit. It's shown as a negative because when we calculate the net income, we take our operating income minus our taxes. And we're assuming that there's no interest in this, that we're paid for this operating investment maybe by issuing equity. So we just have our operating income. Our operating profit margin is going to be our operating income divided by our revenues. Okay. Now, if we want to calculate earnings before interest, tax, depreciation, amortization, we just need to take B22, our operating income, and we want to subtract that, we want to add that to our depreciation. So operating income plus depreciation. Because depreciation is a non-cash charge. So earnings before depreciation are important because it's more closer to our cash flow. And to calculate this percentage, again, we want to divide this by revenue. And we'll just say a margin percentage here. Okay. Now the CapEx is capital expenditure is $800,000 in year one. That's the only year we're paying that. As far as depreciation, we're going to have depreciation every year, and it's going to equal this cell. So I'm going to lock that down so it doesn't drift. Okay. Now our cash flow, we're going to bring down, to calculate cash flow, we're going to bring down our EBITDA. Then we're going to, there's no capital expenditure in the second year. So our net cash flow is going to be $1 million, so our cumulative cash flow is going to be the same. So in this year, our net cash flow, because we took out the capital expenditure, was a negative the cash flow. So we had a negative cash flow plus our capital investment, so that made the net cash flow even larger. Okay, now that I set up year two correctly, in the magic of Excel, I could just highlight, wait for the white plus to turn to a black plus, and pull this across. So now what has happened here is that if we go back, we see that all these formulas I built in are now automatically calculating everything for us. And as we go down, we see our profit margins are increasing every year, almost every year. And that's the reason for the increase in the sales price, because we're increasing our payroll for either we're hiring new people or giving raises to the current people. Our office, our payroll, our office, and our depreciation. Then we have our operating income looks okay moving through. We have our operating margin, our net income, our net profit margins. We're going from 45 to 69, which is a good progression here. We have our earnings before interest, tax, and depreciation. Now here, CapEx, there's a little problem with the formula here. This should just be 0 across. So I need to pull this across like this, and those should just be zeros. So that's why we check. These are all zeros, that's correct. And this is bringing in the EBITDA down here, so everything looks good. Okay, now what we can do is we want to calculate these three capital budget approaches. So I'm going to say, let's reframe this. Evaluate say capital investment. Okay, so that's a better term here. Might as well make that bold. All right, so we don't need the grid lines here, so I'm going to take these grid lines out. No border. So here, I'm going to wrap this cell just so it fits better. Put in some grid lines, and I'm going to put a thick border around this just to make it pop out a little bit more. Okay, so net net present value here. So we're going to calculate the net present value. So we're going to use a finance function called net present value. So what we need here is we need a rate, and it says here 8%, and then we need the values. So the values are going to be the cumulative cash flow or the net cash flow. So I'm going to highlight, actually, year 1, 5 here. Okay, and I'm going to hit done. So this is the cumulative cash flow, the net present value rather. So you see that if you added up the cash flows, that comes to about 20 million. See that little quick sum down here. But the discounted cash flows gives us, after we discount for the time value of money and the 8%, this is the net present value. To do the internal rate of return, we could click that, and then we're going to also highlight the cash flows. So in this case, we just highlight that group. We don't have to put in any guess. So this is the internal rate of return. Now for the net present value, because we're including the CapEx as part of year 1, we don't have to do anything about adding this back or subtracting this from the total later. It's already built in. So that's useful. Internal rate of return, and then the payback period. How we're calculating this is the payback period is going to be, we don't pay ourselves back in year 1 because we have this negative cash flow. So we're not paying ourselves back. But by year 2, we generate enough income to pay back the net cash outflow for year 1. So the way I would calculate this is I would just, I would take year 1, and I want to divide that, but I'm going to multiply it by -1 because I want this needs to be a positive number. And then I'm going to divide this by year 2 cash flow. So, and this is a number, not a number. So it's going to take me about a little bit less than 1 year to pay myself back for this investment. Okay, so that would be my 3 evaluations. So net present value greater than 0 is a good investment. Any internal rate of return above the cost of capital, which is 8%, is a good investment. And any investment I can pay myself back in 1 year is great. So this has looks like a great investment. But we can't just tell our boss it looks like a great investment. We have to calculate an executive summary. So in an executive summary, here, I'm just going to make this text a little bigger. And this part, you fill in the memo. It's 2. You could say, we'll just say CFO from. You can put your name here. And subject. The subject should be similar to what we had here in the analysis, which is acquiring a company. So I'm going to copy this and just move this over here, and then that's my subject. Acquiring a company. Then the introduction is what this case is about. Basically explain that we got this information with certain assumptions at the top, and we did a financial analysis. So in the financial analysis, we need to talk about the profitability, the overall goals of the company, the risk of the project, the opportunity costs, compare net present value, internal rate of return, and payback period. And then in the recommendations, we want to talk about, is this a good company to buy? How should we finance this project? Should we issue equity or debt? And, or use our own cash on this? Just a couple of quick comments, starting points to create a executive summary. So that way when your boss gets this case back, they have all the financial details in Excel figured out here. I think the formulas will show how you did it. And then the executive summary gives a verbal account of your financial analysis of the case and explains what you did, how your calculations could be used to financially analyze the situation, and then your recommendations, which clearly should be to move ahead with this because of the very positive capital budgeting indicators down here. Okay, and then finally you want to save the case. So you want to save your work and then name the case. Okay, so that's it for this introductory financial modeling / financial analysis. I hope you found this useful. Thank you. Take care.